In this video, we'll explore about notes to accounts and financial statement analysis. We have already looked at the four major financial statements, which are the balance sheet, the profit and loss statement, the cash flow statement, and the statement of changes in equity. However, these statements only give you the headline numbers. To understand the story behind those numbers, you must look at the notes to accounts. This is where the specific details reside. It specifies the accounting policies the company has used and provides a breakdown of the information contained in the main statements. One of the most critical sections in the notes is significant accounting policies. Accounting is not always black and white. There are multiple ways to account for a single item. For example, consider depreciation. A company can calculate it using the straight line method, which gives one outcome, or the written down value method, which gives a different outcome. As an analyst, you cannot just look at the final number. You must know which method was adopted to arrive at that number because it affects the profit calculation. Disclosure is key here. Companies are required to clearly mention if they have changed their accounting policy compared to the previous year. This is a major area for you to watch. If a company is continuously changing its accounting policies, it is a significant analyst red flag. Frequent changes often indicate that the management might be trying to manipulate the financials to make them look better than they are. If you see this, you must scrutinize the accounts closely. Next, we have contingent liabilities. These are liabilities that the company has not yet incurred but might incur in the future depending on an uncertain event. Since they are not confirmed debts, they are not recorded in the main balance sheet but are hidden in the notes. Common examples include outstanding lawsuits, disputes with tax authorities, bank guarantees provided to others, and potential warranty claims on products sold. When analyzing contingent liabilities, you have to be careful of management bias. Management will almost always be optimistic and claim that these liabilities will not settle against them. You should not blindly accept this. The analyst's rule is to compare the quantum or size of the contingent liability against the size of the balance sheet. If the contingent liability is large enough to wipe out a significant portion of the company's net worth, you must exercise extreme caution. This brings us to the concept of off-balance sheet items. Think of a company's risks like an iceberg. The balance sheet only shows you what is above the water, like loans. But there is a massive chunk floating underwater that you cannot see. These are off-balance sheet items. They include operating leases, contingent liabilities, and derivatives used for hedging. While positive surprises here are fine, negative surprises can threaten the existence of the business. You must dig into the notes to find these hidden risks. Before we move to analysis, let us summarize some important points to keep in mind. First, do not be intimidated by terminologies. Once you learn the language, the numbers tell a story. Second, always read the fine print. The notes and auditor qualifications are where you find creative accounting. Third, watch for consistency. Changes in accounting periods can distort your comparison. And finally, look for value creation. You want to see consistent growth in sales, profits, and net worth over the long term. Now, let us look at the reliability of these numbers by reading the audit report. The flow of responsibility is simple. The management is responsible for preparing the accounts. The auditor is responsible for verifying the control systems and compliance. Finally, they issue a report. It is important to note that auditors cannot verify every single transaction because the volume is too high. Instead, they verify if the company has adequate control systems in place to prevent errors and fraud. Based on their findings, auditors issue one of three types of reports. The best one is a clean report, which means there are no issues and the accounts present a true and fair view. The second is a disclaimer. This happens when auditors are unable to verify facts because the company did not provide the necessary information. The third and most dangerous is a qualified report. This is a red flag. It means the auditors are convinced that the financial statements do not reflect the true picture or they disagree with the accounting policy used. Once we trust the numbers, we can move to financial statement analysis using ratios. Financial data on its own can be misleading without context. Let us look at the case of Bharti Airtel for the financial year 2019. They reported an operating profit or EBIT of rupees 47.62 billion. On its own, this looks like a large number. However, when we compare it to the interest expense of rupees 110 billion, we see the reality. The profit was completely inadequate to service the debt. This is why we need ratios to compare related numbers and get the true context. Ratio analysis is simply expressing one financial line item as a percentage or multiple of another. We use it for three distinct purposes. First is descriptive studies, which helps us add perspective like calculating margins. Second is diagnostic studies, which helps us understand what went wrong or right in the past. And third is predictive analysis, which helps us assess the future behavior of the business based on past trends. Let us apply this to a diagnostic case study of Bharti Airtel. We have a mystery here. In 2019, the revenue dropped by just 2.19%. However, the EBITDA, which is the operating cash profit, dropped by a massive 13.9%. Why was the fall in profit so disproportionate to the fall in sales? To find the culprit, we must compute expenses as a percentage of revenue. If we look at the cost table in Exhibit 81, the answer becomes clear. We compare the expenses as a percentage of revenue for 2018 versus 2019. Most costs like license fees and employee expenses remain stable. However, look at the network operating expense. It jumped from 23.8% to 27.6%. This tells us that network expenses moved up independently of sales, causing the massive drop in profits. This insight leads us to predictive analysis. We can plot this behavior on a graph. We see that while sales decreased, the network operating expenses did not decrease. In fact, they rose slightly. This indicates that these expenses are largely fixed in nature. They do not fluctuate with sales volume. As an analyst, you can use this fixed behavior to model the next year's expenditure, knowing that even if sales remain weak, these costs will not go down. Finally, let us look at the staircase to value. As an investor, your goal is to identify consistent performance year after year. It starts with sales growth. This should flow down to profit growth. That profit should accumulate to increase the net worth. A strong cash flow should lead to debt reduction. This efficiency leads to margin improvement. And finally, all of this results in an improved return on net worth or RONW. This cycle is what creates value over the long term.